All right. It looks we're at time, so let's go ahead and get started with today's Around the Valuation World International webcast. Before we proceed with today's webcast, I want to go over a few housekeeping items. First, to obtain CP credit, you must answer all the poll questions that pop up on your screen during today's webinar. If you have an AVW International subscription, you'll receive your CP certificates on your NACVA.com portal within 7 to 10 business days. If you have any questions during today's webcast, please feel free to reach out to us through the Q&A feature or also the chat feature in Zoom, and we'll address those for you today. With AVW and AVW International, we try to cover all the hot topics in the industry within the 1 hour that we have today, and also the 2 hours in AVW. We're limited and we don't have enough time to cover all the information. So there are links to additional resources. So if you want to stay abreast on the upcoming hot topics, feel free to click on those links and access that information. This is our editors. We have Wolfgang Nies, Andrew Newman, Pratik Shah, and Brian Jones as our editor. Today we have Andrew Newman joining us today. And today's lineup, we have some GACV news items that we'll mention to you. And then we have Carla Nunes, and I believe James Harrington is not able to join us. Maybe he's a little later on, but I'm not sure. But they'll be giving us the 2026 global economic and market updates. Right, and with the news items, we do have some information. We do have some AI programs coming up. And we have an AI bootcamp that's coming up on February 19th and 20th. And I just want to play a little video for you.
NACVA announces the AI Bootcamp, where experts go to upgrade their skills. Championed by NACVA's Artificial Intelligence and Machine Learning Commission, the bootcamp will be held February 19th and 20th in Salt Lake City, Utah.
Join us at the NACVA AI Bootcamp, where experts go to level up. This isn't just learning new tools, it's leveraging ones you use. Outlook and Word, with the right prompts, they anticipate your next move. Emails draft themselves in your tone, condensed with clean summaries. Meetings scheduled instantly with action items. We used to take 5 steps, now 1. Stop managing communication, start commanding it. Report writing strategies take shape with more clarity, stronger structure, and tone. In litigation, confidence is everything. Imagine your own AI interrogating you like opposing counsel. We pressure test your work before anyone else does, and we use AI to do it.
Catch errors in your valuation or forensic report before a reviewer, opposing expert, or IRS. The result is not just speed, it's accuracy, defensibility, and confidence. Your report becomes cleaner and more consistent. Assumptions get flagged early. Logical gaps surface before they become credibility issues. AI becomes your structured reviewer, helping reduce risk and improve quality systematically. AI is no longer an option, it's competitive advantage. This bootcamp is your chance to get ahead. Join us and start transforming how you work. One prompt, one insight, one innovation at a time.
The question isn't whether AI will impact your practice, it's whether you'll lead the transformation or scramble to catch up. GACVA's AI Bootcamp isn't generic, it's built specifically for CVAs and forensic accountants. Master advanced prompting frameworks for report generation, learn to customize AI for your workflows, discover techniques that cut research time by 70%. 2 days of focused training, real-world applications, skills you'll use the morning you get back into the office.
NACVA's AI Bootcamp, February 19th and 20th in Salt Lake City, Utah. Visit www.nacva.com AI Bootcamp for details and to register.
All right. So hope you're able to, if you're interested, join us. The slide after that, I do have the QR code. So if you are interested in joining, feel free to scan that QR code or visit the website that's next to that. Then we also have some AI resources and webinar series on that page, additional page. So if you're interested and need some more resources on AI and the industry, feel free to scan that QR code as well. And then we have some AVW in-depth sessions coming up as well, where we go in-depth to some of the Around the Valuation World topics during our 2 hours webinar each month. And with that, I'm going to start turning it over to Carla, who's going to go over the 2026 global economic and market updates. Carla Nunes, she has over 25 years of experience, and I can't see this because it's covered up, sorry. In that role, Carla provides firm-wide technical guidance in a variety of valuation, financial reporting, and tax issues. In addition, Carla is the global leader of Kroll Valuation Digital Solutions Group, which produces cost of capital, thought leadership content, and data housed in the Cost of Capital Navigator. Prior to these roles, Carla was part of the Valuation Advisory Business Unit, performing engagements primarily for economic reporting and tax purposes in a variety of industries at Kroll's predecessor firms, PricewaterhouseCoopers, Standard & Poor's, and Duff & Phelps. Carla has authored a multitude of articles, studies, and book chapters, including, for example, Kroll's annual US and European Goodwill Impairment Studies, Kroll's ESG and Global Investor Return Study, and the Valuation Handbook series, and various other publications. She has contributing author to the 4th and 5th editions of Cost of Capital Applications and Examples by Shannon Pratt and Roger Grabowski, as well as the Art of Valuation published by the Appraisal Foundation. It's always a pleasure to work with Carla and have her present with us. And with that, I'm going to turn the time over to her, and she will get us going for today's presentation.
Thank you so much, Shanda, and thank you everyone for joining. I'm gonna share my screen, and hopefully the presentation will. Oh, sorry. I actually want to share my presentation. Bear with me for a second. Share. All right. So thanks everyone for joining this morning or evening, depending on where you're joining us from. I just wanted to let you know that we've had a big blizzard here. I'm in Philadelphia, and so if there's any issues with internet or you stop listening to me in a clear, crisp way, just put it on the chat. I mean, there's always ways, as Shanda has told me, like you can always record this afterwards. Hopefully this will work, but I just wanted to let you know that there could be technology issues because of the storm that went through parts of the United States. So we'll get going, and hopefully everything will go fine. So today we're going to provide a little bit of an economic update and what's going on with markets. So we'll start with current economic conditions in various geographies. We'll show you brand new updates for projected economic growth for certain geographies that we just literally finished updating on Friday. So brand new. And then we'll go through some risk-free rate analysis and some financial market performance. And we'll just very briefly touch on our Eurozone equity risk premium study. So with that, and oh, by the way, as Chanda mentioned, Jim is not feeling well, so he's not going to be able to join us today. So it's just going to be me. But let's start with some mega trends, for context, mega trends that are impacting today's global economy and financial markets. Maybe I should have flipped the order, and say the second bullet, geopolitical risks, including, but among other things, trade and tariff uncertainty. But that's definitely a very big theme that was there last year, and it will continue this year. But the first one there, fiscal stimulus and rising government debt, which could have down the line significant implications for the global economy. We are now seeing diverging inflation trends across major economies. And so they're driving monetary policies in different directions. We'll talk about that. And of course, there's huge investments in artificial intelligence or AI and AI infrastructure. As you saw, it's in everyone's minds, like the boot camp that Chanda just presented as a upcoming opportunity for you guys to learn more about AI, well, everybody is on that bandwagon and it's in fact affecting the entire economy. And then, of course, and I'm not going to talk about this in the presentation, but we shouldn't forget the continued rise in things like private markets and digital assets and issues related to energy transition. So let's get started first with, uh, the current economic conditions. And so we'll get started with the fiscal situation. And the reason why we start with the United States, it is still the largest economy in the world, and it does impact what else is happening elsewhere. So the the US is not unique, but the federal government debt, so the total debt issued by the government versus nominal GDP, so the size of the economy in the United States, the debt component has been growing quite significantly. So this chart shows you that, around between the dot-com crash, the 2001, and the global financial crisis, we were talking about average debt to GDP about 60%. And of course, with the global financial crisis, and this was not unique to the US, we saw a rising in government debt. So a lot of that was like bailouts and trying to restart the economy. But we reached the pandemic, COVID-19, and that's when things really got out of control. And this is, again, not unique to the United States, but certainly the United States issued significant amount of debt for a lot of the COVID-related packages. They were the biggest in size than anyone in the world, both in dollar amounts, but also as a proportion of GDP. And so we're now at around 121%, the latest, the third quarter of 2025 of debt to GDP. So why do I care? So for a moment, let's look at what using data from the IMF, what it looks like for other countries. We have most of these are developed countries. We have India on the right hand side. What this shows you is what the actual debt to GDP was in 2024 versus what the IMF expects to be in 2030. So this would be the green bars. And so just, by the end of 2030, so in 5 years, what we will see. And we can see that Japan leads the pack. Japan is a unique circumstances because they always had the domestic buyers really buying Japan's debt. So they've been able to carry different levels of debt than anybody else, and even but still have an A plus S&P rating. But please note that even Japan is not completely immune to what's happening. So last week we had a major crisis in global bond markets because the new Japanese Prime Minister Sanae Takaichi announced that they were going to for temporarily reduce the consumption tax to zero. And so markets thought, oh my gosh, how are they going to fund that? And if they're going to fund with more debt, they already have so much debt that really led the 30-year yield on the Japanese government bonds to a record high. So we see the same thing. The United States debt is actually expected to grow quite a bit compared to where we are today, 5 years from now. We see the UK is expected to grow a little more, and then Germany with the rearm plans after the US administration said they wouldn't finance NATO as much, that Europe needed to finance its own defense. We've had a big package from the EU, but also a separate one in Germany, indicating that the government will be spending more to finance infrastructure spending and defense spending. So all of this is causing issues. France, for example, they haven't been able to pass their budget in a way that has caused a lot of political uncertainty and led S&P to cut France's rating recently. So we showed there when recent changes to ratings. Now India is actually an exception in that it's expected to decrease debt to GDP, but part of that is because of the growth in GDP is still so significant that you're able to have debt become a smaller proportion of the overall economy. But the repercussions for having so much debt could be dire if investors stop being confident on the ability of governments to pay back their debt. And so it's an issue of credibility. And so the IMF, just to give you an example, estimated that the rise in US GDP will be about 21% debt to GDP. So why do I care? Well, this is a summary of 3 different papers, recent papers, that have looked at what's the impact of increasing debt to GDP on US long-term yields. So think about the 10-year yield as an example. And so they seem to conclude all of these that for each percent increase in debt to GDP, we'll see 2 to 3 basis points increase in long-term interest rates. And you think, well, 2 to 3 basis points, that's just like a rounding error. Yes, but I just said in the prior slide that you are expecting to see a 21% rise in debt to GDP. So that means we're talking about probably like 30 plus basis points increase on a permanent basis to long-term interest rates. So if you're doing a valuation, when you're approaching to, in some cases, 0.5% is not a big deal, but in some valuations, 0.5% on your risk-free rate assumption might be quite significant to the valuation conclusion. In fact, because investor confidence is that I was just talking about the credibility and the debt capacity that countries have. So what you can see here, just updated country risk premium, as of December 31st of 2025 from our study. So looking at yield spreads from a euro-based perspective, what we can see is that France's, investor perception of risk relative to the German Bund has gone up. So this is part of the reason why they got downgraded by S&P. So now they're 1%, and they're like the same country risk premium as Italy. That Italy has more debt, but it's about credibility. Can France continue down this path, or can they do something to shore up its finances? Versus Italy has been on a path that is expected to improve. So it is interesting how you see that impact on financial markets based on the credibility that countries have of paying off their debts. Now, going into a economic growth, we'll start first of like what's been happening with the United States. So the United States has been surprisingly resilient since the 2022 like rise in interest rates, and inflation was at the 40-year high. Interest rates were increased quite significantly at that point in time, and a lot of economists said, well, that rise in interest rates is going to cause a recession in 2023. Well, that didn't happen. And then they also said, well, it's going to cause in 2024. That also didn't happen. In 2025, they thought, oh, growth is going to really decline after Liberation Day and Trump's announcement of what he called the reciprocal tariffs for the entire world. And so what we saw was a negative real GDP growth in Q1 in the United States, but that was because of these policies, because the administration had announced already that they were going to impose tariffs, but we didn't know all of the magnitude of what they would be in April. But a lot of businesses decided to purchase products ahead. They imported much earlier. They anticipated their imports in Q1 in anticipation that would be tariffs, so they don't want to pay the higher price. And so that was so significant that because imports are a deduction or a subtraction to real GDP growth, it led to a contraction in Q1. But in Q2, that was offset because then you stop imports because inventories were available to the various businesses and consumers. And in addition, we saw a surge in artificial intelligence, AI spending. Q3 was even greater in terms of growth. Nobody was expecting this level of growth. We'll see what happens in Q4 because in the last quarter, the US had a government shutdown, the longest in history, and that means that there'll be some negative impact on GDP for the first half of the quarter. So it's still hard to predict what's going to happen, but by a lot of external economists are actually saying they will still be around 4 to 5% because of the AI contribution. So a lot of people are attributing growth not just in the United States, but other places that the AI is contributing significantly. So we decided to look at what really the truth is about the contribution to real GDP growth. So this is very hard to get exactly which measures in government accounting really capture AI because it's a new thing. So all we can do is do approximations. We can say, hey, there's a lot of computer equipment and peripherals, data centers, etc. That are coming through, that accounts, and also deployment of AI in software, not just the companies that make the software, but those who buy it. And so this is a simplification. So we're not capturing, there could be software being bought for other reasons other than AI, and you could be buying computer equipment and related data and infrastructure that is not related to AI. But under the simplification that all these accounts are AI related, we measured how much of the GDP growth really is accounted for AI contribution. So the green portion is computer equipment and peripherals, and the blue is software. So if you remember, Q3 from the prior slide was 4.8%. Now 4.8% overall growth, really only a small portion, 0.4%, was related to AI spending. It was better or a better contribution in Q1 and Q2 of this year, meaning together it was close to 1% of growth that was attributable to AI spending, which is very strong. But at the end of the day, consumer spending in the United States still account for about 2/3 of overall growth. And so we cannot forget about the wealth of the consumer in terms of contribution to GDP growth for the economic size. So it's just trying to get you a sense of sometimes there is some exaggeration because you hear all these headlines about AI, but a lot of this AI spending is expected to be over, say, 3 years, 5 years. We only see the top line of big numbers, but that doesn't mean that it's right now that's what's happening. So there's actually economic papers that estimate AI in the United States could be about 1% permanently, contribution to GDP growth based on efficiencies and productivity growth. So this seems about ballpark, but what that means also is that there's also the fears of an AI bubble. So maybe the contribution is not as much as people are saying in the headlines. And so this shows you something that it's called the Shiller. He was a Nobel Prize winner in economics, and his famous cyclically adjusted PE ratio for the S&P 500 index. And what it is it gets a 10-year trailing earnings for S&P 500 adjusted for inflation and just says what that PE ratio is. And what we can see is that the latest PE ratio at the end of December is below, but reaching quite close the internet bubble heights of 44.2. And we know what happened after that. We had a crash, right? And so, always people say, pundits always say, this time is different. But there is a possibility that, yes, AI will be life-changing. It will contribute significantly to economic growth. But we could also have at the same time market corrections, because some of the anticipated growth there are in those companies is not going to come to fruition. So we are getting pretty close and certainly above what the post-World War II P ratio of 20.6, around 21, has been. So we could see some corrections. And in fact, we are currently seeing in the markets in the US that investors are falling a little out of love of tech stocks, meaning that the S&P 500 is rotating to other sectors as well. In the meantime, I told you that the consumer was a significant portion of the U.S. economic growth, and the consumer matters a lot. And this shows you the consumer confidence measured by the University of Michigan Consumer Sentiment Index for the United States. And what we can see here is that as of December, the consumer confidence was almost the same as the historical low that was reached in June of 2022. It's above that, but not much above. So the question of affordability and continued high prices, even though inflation as a percentage growth has been coming down, the prices are high, and they will stay high. And there's been a tariff impact on some categories. And so consumers are not very happy. And so for now, they have kept on spending, but they are getting into debt. And so you could have an issue of retraction if inflation doesn't get under control. I'm going to just give you a little bit of like an issue that this impacts monetary policy, because monetary policy in the United States, unlike other countries, is really looking at two mandates. One is keeping prices stable around a target of 2% inflation rate, and then two is job stability. So they call it the maximum employment that you could have without creating inflationary upward pressures. And so what we have been seeing is that job creation has been cooling down in the United States, and the revisions are negative for the most part. So what we see here is in blue what the street, so economic forecasts and from investment bankers and professional economists, et cetera, what they were expecting, the number of jobs that would be created in the United States since June. That's the blue line. Then the green line is what it actually was reported when the report came out. And then the orange line or bar is actually what was the final number, because the green is the preliminary number and then it gets finalized. And so what we can see is that in general, the revisions have been negative, that when you get to the final number, it's actually less than was originally reported. Of course, on the October, we're missing the preliminary, because the government shut down. A lot of the data was not provided. And so the government shutdown has like a one-off effect. That's not a good number to look at. But certainly we're seeing that now job creation is more maybe around the 50,000, whereas before used to be more around the 75 to 100,000. And so the Fed is thinking, oh, we don't want to get into recession. So if we think we're going to get into recession, we need to cut rates. Oh, but we still have inflation. So what are we going to do? So it makes it harder for them. I'm going to just look at the questions just to see if there's something. Okay, no questions that I need to deal with. So anyway, this is what's going on in the US. Unemployment rate is still pretty low by historical standards during recessions. 4.4 is still pretty low, but you don't want to get it to be significantly higher than this. 4.4 is actually not, considered to be significant, but there are companies that are announcing layoffs in like large banks and even in AI related functions where there's starting to be some impact of AI of like less hiring for sure. In fact, there's stories that with AI, maybe you don't need to hire as many people on a monthly basis. Maybe you are permanently on the called the break-even rate at around 50,000. But so let's see what happened with all this uncertainty in the Eurozone specifically. So it hasn't been pretty. We did have a Q1 of 2025 that really above what it had been seen since 2022, but that was because there was acceleration of purchases of imports by the US companies and consumers accelerating imports that came from the EU. And so that benefited that first quarter of 2025, but then that sort of reversed in the second quarter. And the third quarter was at a better level. It seems like the recovery, the tariffs were not as bad as was once anticipated, and we'll see a chart on that. But it has been a struggle to recover from the 2022, dual whammy of the Ukraine's invasion by Russia, as well as a surge in inflation and increase in interest rates. So Europe is expected to grow from this, but we'll talk about that in a second. Consumer confidence in the Eurozone is better than it was back in September of 2022 when interest rates surged and inflation was also at 40 years high. But it's still not above that 100 level, which is what you'd expect when things are very optimistic. In Canada has been struggling quite a bit from the impact of the US trade policy. So they did have a little bit of an increase in Q1 from also acceleration of imports, but then they had a contraction in the second quarter. Canada has been struggling to recover from the 2022, the post 2022 situation. So they have been like sluggish. They still have high unemployment. Their target inflation rate is starting to get more, the existing or reported is getting closer to the target, but there's a lot of issues that are, in Canada and a lot of these countries. So Canada and a lot of the countries in Europe, the governments are going to actually replace probably the private sector with some investing because there's a large economic packages that have been announced that are debt fueled. So governments will be issuing more debt, and we know what I said before about debt. But that's the expectation, but it's been subdued growth. So talking about inflation, remember most of these countries have a 2%. In fact, here they all have a 2% target, or a band that is the median is 2% target. And so this is the latest readings on inflation year on year as of December 2025. In a lot of these countries, we still continue to see a services inflation being much higher, sometimes double from what the core inflation is, and the overall headline inflation is. So this is a measure of a headline inflation, what you see in the news. The Eurozone and Germany seem to be the ones that have it most under control, which means that probably rates are going to be steady in terms of but there's more room to cut rates if necessary, if the economy goes into lower growth. So that's something to take into consideration. The UK is in really hard position because they continue to have really high inflation relative to target, but their economy is really slowing down. So I was talking about, what is core inflation. In most countries, core inflation means you exclude energy and food prices because they're very volatile. In Europe, in Germany and in Eurozone, you also exclude things like tobacco. But in any event, you can see that the green bar, which is what I was talking about, continues to be much higher than the overall inflation, which is services inflation. That's true in Canada, true in the UK, true in Germany, true in the Eurozone. So the prices there are stickier. It's harder for those prices to go down, and they will contribute to the overall inflation. So that's what we're seeing in inflation in the US. The Fed also looks, their preferred method is actually something called the Personal Consumption Expenditure, or PC, price index. And that has been now approaching the overall headline inflation, but there was a little bit of a uptick in October, which is not a good news. You want this to be going down. In fact, since April of 2025, prices have generally been going up as opposed to down. So that's worrisome. And the government shutdown is going to alter some of this picture because some numbers were not available. And so we don't have a full picture of inflation. But this is just telling you the cumulative inflation in 1 year from January to December of 2025 in the United States. What was some of the tariff effect? So tariffs were not as high as they were anticipated back in April, obviously, because there were pauses and then there were pullbacks of what the tariff rates would be. So it's not as bad as it could have been, but we can see, like, in the orange lines are the ones that are directly impacted by the tariffs, and coffee is right there on top, like, 16.7 17.6% increase. You can see things like audio equipment and beverage materials, coffee and tea, lettuce, tableware, cigarettes, etc. So when I was saying that the consumer is still feeling the pressure, particularly the lower part of the consumer in the income distribution, they're feeling the pressure of these higher prices, and some of the tariff effect will linger on for a while longer until it became steady state. So I talked a lot about current conditions. So very briefly going through the expectations. So as I said, things are not as bad as they once were thought of once Liberation Day came. So steady state world economic growth is expected. But a lot of that is contribution by, believe it or not, the United States and China and India. So in the United States, as I said, at one point people thought there was going to be a recession because of tariffs. That didn't happen. In fact, the economy has been on steroids. And part of that is also 2026 will benefit from this one big, beautiful bill act, which is a huge tax package that is expected to cost around $3 to $4 trillion in 10 years in terms of US government debt, but is expected to stimulate growth via, some cuts to income taxes for consumers, but also business incentives. So some actually say that between the OBBA and the AI spending, there could be overheating in 2026, but for now, 2.2 is the expectations for growth for the United States. Now, if we look at the Eurozone, it's still expected to be somewhat subdued, the recovery in 2026, and 2027 will start a larger recovery. Part of this, again, remember, there was the rearm Europe, and there was a big package of several billion euros in terms of incentives that the EU is planning to implement over the next few years in terms of defense spending and infrastructure, and even in energy transition. And so it will start being reflected in growth numbers down the road, but for now, still expected to be subdued. But this is what I wanted to show you when I said that things were not as bad as they were expected to be when Liberation Day came. So this gives you an example of, expectations as of January 2025, what real GDP growth was expected to be for the United States, Eurozone, and the world. And the most recent expectations for 2025, we don't have the final numbers for 2025 yet. It will be a little bit. Is that in terms of the Eurozone, it's actually better than it was at the beginning of the year. And the United States is not as good as it was in the beginning of the year, but it's certainly better than it was, for example, as of September 2025. Canada, as I said, continues to struggle in terms of growth, but Mark Carney, the Prime Minister in Canada, has announced also a significant stimulus package that is expected to bring growth back in 2027 to increase. And then finally, India. India has really been the bright eye in the economy globally. I mean, they continue to grow at a significant pace, even though it's expected to decelerate in 2026 relative to what it was in 2025. So that's like the next 2 years if you're looking at our valuation, but also an important component is going to be the long-term real GDP growth for, if you have a terminal year in your DCF, what do you look at that number? And so there's always this thing that you shouldn't be able to grow above the economy. So let's see what is the long-term projected real GDP growth for the United States. The median of these sources that we look at is around 2%, which is slightly higher than what it was a couple of years ago. It used to be more like in the 1.8, 1.9. It's starting to gravitate towards 2%. So I think some of these economists are these are like usually like 5 to 10 years type expectations, that they're starting to think that the productivity enhancements from AI will get the potential for growth a little bit higher. And inflation, even though the 2% target is what the Fed wants to achieve, it seems like, because expectations from economists is not quite that level, so they think that it's going to stay over the long run at 2.4%. So if you put these two together, long GDP for the US and long-term inflation forecasts, you get to a long-term nominal growth rate for the United States of 4.4%. And so you have to think about in your terminal year value calculations, depending on how many years you go out in your DCF, of how much your company can grow relative to the overall economy if you're doing US dollar-based valuations. Unless you're in the technology field where it could grow for quite a bit above the overall economy, over the really long run, you can't really grow above the economy, or you would become bigger than the overall economy. So, so something to benchmark against. And we have the same sort of analysis for Germany. Germany's potential growth rate and the long-term growth rate is expected to be lower than the US by a significant amount, so 1.4 or 1.3, depending on where you look at, and which is why we also would expect interest rates to be lower in Germany. And if you look at inflation rate, as I said, they were actually getting to that target of 2%. They're there. So if you think about a long-term average nominal GDP, this you're talking about 3.3 to 3.4. The median of these estimates. And so I'm going to say we use this data for our implied equity risk premium analysis for the Eurozone. So that's one of the inputs we use. I'm going to pause just a second, just see if there's any questions here. There was a question about the quarterly adjustments, whether they're cumulative. Right. So what we're talking about, the adjustments in GDP that I showed earlier, they were annualized rates. They're not like the individual growth from one quarter to the other one, is that if you were growing on an annual basis. And the part of the reason why it's shown like that is to be able to compare countries across. The United States always reports it like that. So it's to be able to compare international statistics. So with that, very briefly go through some of what's going on with interest rates. And your risk-free rate analysis. So here, this chart, just for comparison purposes, we show 10-year yields for the UK, US, Canada, Germany, and Japan. So the major economies and interest rates that are followed globally. Now, I would say one thing, and sometimes we use different maturities for the risk-free rate. But because there's no consistent maturity for all of these countries, the 10-year is the one benchmark that we can compare across all of them. And what we can see is, and I can say something, this is all only through the end of December, but one interesting thing is what I said about Japan. Japan, it's the green line on your screen. It's the lower curve you can see there. And for a while, from 2016 to 2022, they had a quantitative easing and qualitative and quantitative easing that really targeted the 10-year yield to be 0%. And so they would buy bonds or sell bonds to keep the yield around there. So this was not really a market-based rate. And that was also true for the European Union, the Eurozone, and true for certainly the United States, where QE, particularly after the declaration of COVID-19 being a pandemic, that interest rates were cut to 0 or even negative. The Eurozone had negative policy interest rates for quite a bit, but significant quantitative easing purchases that drove down yields. In fact, in the United States, for example, it reached a record low just in the aftermath of COVID, 0.5%. And of course, if you're looking at your valuations, like that is not expected to persist, and you would come up with a value that is probably too high if you were to use those rates without some thought. And sure enough, after the surge in inflation in 2022, we saw rates rising. Last week, I told you about the Japan and that really mini crisis. But what we're seeing is also the UK has been struggling with inflation and has been struggling with credibility by governments to reduce debt. In fact, the idea was that to increase debt as fiscal policy and fiscal stimulus. And so investors are a bit concerned about what those repercussions will be down the road to the ability for them to pay their debts. And so we're seeing interest rates that are at similar levels as they were pre global financial crisis of 2008, 2009. Now, we at Kroll, we were doing something called a normalized risk-free rate, or call it the fundamental risk-free rate, to do an analysis of where really your risk-free rate should be. Now, we never said you have to use our normalized risk-free rate. No. What we said was we were looking at, during times where there was quantitative easing and manipulation of markets by central banks, that we would look, at least if we're going to look at the equity risk premium relative to a risk-free rate, we need to look at it relative to this normalized rate. And if you wanted to do a spot, then you would want to adjust your equity risk premium. Now, why do we still update this every month? Because it actually impacts also what central banks are going to do. And part of that is that real rate expectations versus inflation. They look at this when they're coming up with what they call their neutral rate. So the neutral rate, the way they call it, is that interest rate policy rate that would prevail if there was no upward pressure on prices and there was stability in employment. So nobody used to talk about this neutral rate, which is also known in academia as the natural rate of interest, equilibrium rate of interest. Sometimes they'll call it R star. And nobody was talking about it. We had been looking at academic papers since 2015, and we have been gathering them. And every month we take a look at it. Now everybody, even in the newspapers, talks about the neutral rate, which they did not used to do. So, for example, Michelle Bowman, one of the governors at the Federal Reserve, said the neutral rate level for the central bank's policy rate has likely risen since the COVID-19 pandemic. This was a March 2025 article. Then the New York Times said a different article that one of the governors, Steve Mirren, who was a supporter in the economic team of the Trump administration, he thinks it's the other way around. He wants lower rates, and he thinks that the neutral rate should be lower than what a lot of these central bank officials think. And so they're saying opposite of what the majority of the Fed officials are, estimating. And then, interestingly enough, in December, the Fed, in its minutes, talked about normalizing interest rate policy, and they think that once the labor market and inflation stabilize after the impact of tariffs have subsided in the data, that they look at a plausible range of estimates of neutral rate. Now they talk about neutral rate on a nominal level, whereas we were looking at real. And so the one thing that is interesting is that they realize that they may need to stop their quantitative tightening. So they have a return for a mini quantitative easing, which they're getting worried that all of this fiscal spending by the US government is going to impact rates. And remember, the US risk-free rate, which sometimes people are now thinking maybe it's not so risk-free, but it is still the basis to price a lot of the financial assets across the globe. So it's a big deal. But anyway, so we look at these estimates of real rates, and indeed, they have gone up. So to give you an example, just for 2025, now remember, we have been going through since 2015, and there's a lot of academics estimating. And right now for the United States, they think that the real rate over the long run for the United States would be even above that 1% you saw by the economists' real GDP growth. So something to consider. And the Fed will consider that as well in their estimates when deciding, if you add the 2% inflation target, what should that interest rate policy should be. And so for now, we have a 3.5 to 3.75% range, target range for the Fed policy rate, so the Fed funds rate. And nobody's expecting rates to really be cut now in January this week. And we may be actually waiting until the new Fed chairman comes in May to cut rates further. So for now, we're not expecting a rate cut, but rate cuts in December and earlier were really inducive to market and M&A activity. This is the deposit rate for the European Central Bank. We've been at 2% since June 2024. And it probably will stay around here for a while. I have a chart that shows that. And this is Canada. Canada did cut rates recently in October, but they saw a little bit of a re-up in inflation rates. So they're like in that struggling mode of the economy is slow, and yet they still have some inflation to fight. These are just for reference what the interest rates are for each of the central banks, including India. India actually also cut its rate recently in December. So as we can see, Japan is actually going up, and then some of these are going down, and some are staying the same. So that's what I meant by diverging monetary policies right now. And these are the expectations for the next year or so. And as we can see in the ECB, we can see that it's around 2%. It's going to stay there, whereas in the US is about potentially 1 to 2 rate cuts this year. And now quite shortly, we just have like 5 more minutes left, show you some of the financial market performance and what has happened. So we can see that after that scare in April and that tariff flow, the S&P 500 has increased 36.4% to today. Now, that's in US dollar terms. If I were to measure this in euros, for example, it's only like around 3 to 4%. So the US dollar has declined quite significantly. And so it hasn't been for other investors, they have been able to do better in their own countries than investing in the S&P and have that exchange rate risk. So this is an example of financial market performance is the beginning of 2025 until like January 21st. And you can see that the US wasn't even the better one, but if it was inflation adjusted, this is local currency, remember, the US would not really be that outperformer anymore compared to, say, Germany or the UK or Spain. And part of this is being that the expectation of fiscal stimulus coming down the pipeline that will, really benefit some industries like defense and infrastructure type. And also because, let's face it, tariffs were not as bad as anticipated back in April. Now, in the US, a lot of the outperformance is being related to AI and this Magnificent Seven companies, but the outperformance now is shrinking. So in 2025, which is the last column on the right-hand side, you have the green for Mag 7, you have the S&P 500 market cap weighted and then equal weighted. And the difference between the Mag 7 and the other sectors, 18 versus 20, is not that different. In fact, we can see here that the Mag 7 2025 versus 2024, it was much smaller than, I would still take NVIDIA's 39%, don't get me wrong. But Alphabet is the exception because there's been a lot of talks that their AI is actually superior, potentially, the Gemini, to others. And so they actually gained quite a lot in 2025. Whereas the stock 600, the increase since the tariff flow is not as large, but it's still pretty impressive, 28.3%. And so with that means that our equity risk premium recommendation for the Eurozone, we're showing here the factors that we consider when determining the the Eurozone ERP from a German investor perspective. And since April, all of the factors in the markets are really down. GDP is slightly better than it was, and other factors in the economy are stable. And so we are looking at, should we change our recommendation for the equity risk premium? And for that, we look at quantitative models. I'm just going to focus on the bottom one there, the dividend discount model based on top-down projections, meaning that we look at various different models for expectations of what earnings and dividend growth is going to be, what's the long-term risk-free rate, what's the payout ratio, and then we look at these models. And the Modern does this, other people do this, but I just want to demonstrate that these models are very, very sensitive to the assumptions you make. And so if you look at them, you can only see where the risk is trending, as opposed to looking at each one model. You can have a lot of conclusions that are very different from each other. So we take a median of this, and what we can see is that since that little hike in April, that the top-down implied ERP estimates are coming down to below 5%, which hadn't happened since like 2017. And so based on that, this is our current guidance as of December 31st, 2025, where we have a 5.5% to 6% range, but we said that we think that 5.5% is the range that is, the 5.5% is more likely as the ERP for the Eurozone from a German investor perspective. But now we're actually thinking of shifting that range from 5 to 5.5. We're still at 5.5 in a sense that this instability of tariff bargaining chip to say, I want Greenland or whatever, like Trump administration feels like it is still uncertainty around what could happen, but we're certainly seeing investors thinking that ERP is now lower relative to what it was, and partly because also the German risk-free rate has risen under the expectation there will be more spending. And with that, I'm not sure that we had, more time for questions. But Andrew, just anything that you wanted to, I'm gonna stop sharing.
Thank you, Carla.
Yes.
Excellent presentation. A lot to consume there.
Yeah, a lot of content. There's a lot going on for 2026.
Yeah. And a lot we don't know.
A lot of uncertainty. Yeah.
And I'm wondering how that factors into those rates, the high level of uncertainty.
Yes, absolutely. It's going to be challenging. We may need to have a mid-year update.
Yeah. The other thing that you made me think about was that in terms of some of the rates, they don't take into consideration energy and food, which is such an important part of the G7 economies.
And a big component of like what you and I feel like when we go to the supermarket and when one of or go to, like to buy food, like we feel the food prices, right? Or
Absolutely.
yeah,
And when you get your bill for either heat or air conditioning, or you go to the pump, and it'll even
exactly,
affect the EVs because they're starting to charge for recharging EVs now.
exactly.
Yeah,
Yes, yes. And so those
yeah,
are such a big component of the household budgets.
yeah.
And yeah,
I'm also wondering how valuations are affected because some companies are now, although they may be, for example, investing in organizations in Great Britain or in Europe, but they may be using American financing sources. So then you've got in terms of the cost of capital, you've got two components. You've got foreign currency component as well to take into consideration. That's what the question was really intended in terms of chat, but I couldn't have developed it enough.
yeah.
Uh,
And it's a great, I mean, that's one thing that you have to be really careful about in a valuation, that it includes valuation streams, like cash flow streams that are in a different currency. Which exchange rate do you use to translate those? And if you just do a spot rate, you may be introducing significant error on the valuation,
yeah.
or so that's something that is quite important actually in such a volatile foreign currency uh, world where so it's very important. If a lot of the, like for example, a lot of energy has been coming into Europe from the United States, a lot of those commodities are priced in dollars globally, so it's something to consider of like where is that gonna go and how does it impact evaluation.
And also the effect of crypto taking on a more prevalent role. Uh,
Yes, absolutely.
yeah.
The talk about whether there would be a digital currency issued by central banks, for example, it doesn't seem like it could be something that would happen here in the United States, issued by the Fed, but it could happen in the European Central Bank, for example. And interestingly enough, the US administration is trying to create demand for US treasuries by making it easier to create stable coins. And and part of that is really to say, hey, because stable coins are backed by US treasuries, we'll create demand for US treasuries. Therefore, because if foreign investors don't want to hold US treasuries anymore because they want to diversify away to gold and other markets, but I'll replace that with stable coin, demand so that interest rates don't go up as much in the United States. So it's a lot of moving parts that are going to be difficult to understand what's going to be the ultimate result.
Thank you so
Yes.
much.
Yeah,
Thank
great
you so much.
information. Yeah, thank you, Carla, and thank you, Andrew. And thanks you, thank you everyone else for joining us for today. So the slide on the screen indicates that our next webcast is going to be on February 23rd, 2026. Hope you guys all have a great week, and we look forward to seeing you next month. Thanks again, everyone.
Thank you so much for having me.